If you compare the move that we've had since we've broken, we've broken definitively above 2000s back in the beginning of 2024, right? It's a good, healthy move, but you compare it to the move we had from 2001 to 2011, we still have a lot of time left, in my opinion, and a lot of upside left and downside for currencies as well. And if you compare it to the 1970s bull market, the same thing. And this chart, of course, is a logarithmic chart. It's not an arithmetic chart, which makes the current move look parabolic, right? And so to me, you can't even see the correction we've had in the last week or so if you look at the quarterly chart. And I wouldn't be surprised if at the end of the quarter, i.e. at the end of March, we're a lot higher than we're now. It settled yesterday, gold just below 5,000, 4,964. The pointlessness of holding bullion continues to sink in, right? It says the barbarous relic, as Keynes called it, is crumbling to dust. When even the venerable N.M. Rothschild has quit the gold market and the Bank of France, among the most stubborn of the official gold bugs, is thinking again about its bullion holdings, the end of gold as an investment has come a little closer. While they mentioned the Rothschilds, they quit the LBMA and the price, the fixing that they used to do in their office for like a very long time. They quit that in 2004. And you've seen that that guy Epstein, he was a representative of the Rothschilds, right? So I wouldn't even put it past the Rothschilds if they went to the FT and told them to write some rubbish like that, because they probably wanted to buy and they didn't want the public involved, right? And gold at the time was breaking back above 400. It had been down to 250. So I wouldn't even put it past the Rothschilds to be doing some manipulation there. Yes, they got out of the LBMA, but you can bet they've got a lot of gold still, and they're probably still buying it. Anyway, it says it will not be before time. The fetishization of shiny yellow metal, decades after it ceased to be used as the anchor of the international monetary system, is a lingering anomaly in modern financial markets. Perhaps Rothschilds, there you go again, mentioning the Rothschilds. And they're very close as well to Peter Mandelson, right? Which is a really sordid story. Anyway, let's continue. Perhaps Rothschild's last service to the bullion.
Mario Innecco recently revisited one of the most repeated claims in finance: that gold is pointless, outdated, and on its way out. The headlines say the barbarous relic is finished, that even the Rothschilds walked away, that central banks should abandon bullion altogether. But as Mario Innecco explains, when you look past the narrative and follow the actual behavior of institutions, the story completely falls apart. Because if gold really were obsolete, the people who understand money best would already be gone. They aren't.
Market could be to keep a live gold trader on display behind glass as a reminder of a bygone age, like the former coal miners who make a living giving tours of defunct pits. The one advantage of gold as a reserve asset is that, unlike assets based on fiat money, governments cannot make it worthless by inflating it away. Well, they got that right. What they got wrong is what they say next. But in an era of low inflation, and given that independent inflation targeting central banks are the norm across the industrialized world, that risk has very sharply diminished. Indeed, for both private and official investors, gold is now a rather risky asset with a nil or low return. And it's weird because over the years, friends, colleagues, family, they've asked me about gold, and I say, yeah, you should have some, you should buy some. And almost all of them say it's too risky. So you can see how this affects the narrative. The intrinsic value of gold, determined by its use in various industrial processes, is well below its market price. Gold does not grow, so its value to any one investor as an asset is dependent on other investors also holding it as an investment asset. The gold price hangs precariously by its own bootstraps. For private investors to hold gold on this basis is their own foolish affair. So there you go. You're a conspiracy theorist. You're foolish. For central banks and governments to hold it as a reserve asset is a betrayal of the public on whose behalf they're acting. Well, I think the betrayal was Gordon Brown selling half of the UK's gold. Gordon Brown, he betrayed the public because he sold the UK's gold below $300, and here we are now near 5,000. Despite recent sell-offs, governments and central banks still hold about a fifth of the world's bullion. Their large holdings relative to the size of the market by themselves make gold particularly ineffective as a reserve asset. Tell that to the central banks who've been buying hand over fist since 2022. They've done very well. And foreign reserves held by foreign central banks, non-US dollar central banks, their holdings of gold has overtaken the fiat dollar, or the I owe you nothing dollar, right? The very active official selling of bullion on any large scale to raise cash will itself drive down the price. This danger was amply demonstrated by the UK's unhappy experience to trying to sell some of its gold holdings. Pre-announced in 1999, right? They say announced, but Gordon Brown pre-announced it. I'm sure he was in the pockets of the bullion banks, and they said, we need the price lower, or Mrs. Rothschild said, we want to get gold cheap. Pre-announced it, Gordon.
Mario Innecco starts by dismantling the core argument against gold. Gold has no yield. Gold doesn't grow. Gold has little industrial use. And therefore, critics claim its value exists only because people believe in it. But that argument misses the point entirely. Gold is not a productive asset. It is a monetary asset. Its value comes from what it doesn't have, no counterparty risk. Fiat currencies are promises layered on top of promises. Gold settles accounts instantly. No trust required. According to Innecco, labeling gold holders as irrational is a convenient distraction, because that same skepticism is never applied to exploding sovereign debt, negative real yields, or balance sheets dependent on perpetual refinancing. If there is a mania in the system, it isn't precious metals. It's government debt. History backs this up. When the UK pre-announced gold sales in 1999, prices collapsed. Public value was destroyed. Insiders benefited. The damage was so severe that central banks later signed agreements to limit coordinated gold sales. Innecco points out the irony. Those events weren't proof that gold failed as a reserve asset. They proved its monetary power. Assets that don't matter don't move markets. Assets that don't matter don't require international agreements. Now fast forward to today. Since 2022, central banks, especially outside the Western Bloc, have been buying gold at the fastest pace in modern history. In many cases, gold now rivals or exceeds US dollar reserves. This isn't nostalgia. It's a reassessment of risk. While public commentary downplays gold, Official actions reveal growing concern over currency debasement, sanctions risk, and the long-term credibility of the dollar-centric system. As Innecco stresses, if gold were truly obsolete, central banks would be rushing for the exits. Instead, they're buying quietly, steadily, and aggressively. Zooming out removes the noise. On multi-decade, logarithmic charts, gold's recent surge barely registers as extreme. Compared to the 1970s or the 2001 to 2011 cycle, this move is still early. Breakouts above historic resistance levels signal structural change, not speculative frenzy. Short-term pullbacks vanish entirely on quarterly charts. Gold doesn't grow because it doesn't need to. It measures the decay of currency itself. And that decay is accelerating.
Announced in 99, yeah, in a sensibly open, it wasn't sensible, and transparent fashion, the sale sparked such a fall in the global bullion price that a group of central banks signed a concord limiting such sales. That has recently been superseded by a new agreement providing for limited official sales. Given the pointlessness of holding gold, the speed of its official sell-off scarcely matters unless leaching the gold into the market bit by bit somehow maximizes the return to the public purse by limiting the impact on the price. That would imply some irrationality on the part of the market, but then holding gold is irrational in the first place. Perhaps the central banks are right to go slowly. Whatever the speed, the direction is clear. Gold is on its way out as an investment and a reserve asset. 3 cheers for that. So there you go. Yeah, the reason I laminated this, of course, was that I thought this is going to be timeless. And it has proven to be. And at the time, I still worked in the City of London as a futures and options broker in the government bond market. And I had the guys in the office, the guys in the mail room. They had a laminating machine, and I took that down to them, and they laminated it for me. So there you go. And on that day, gold was at $400 an ounce. Maybe they didn't want gold to go above 400 because if you look at the long-term charts, that was a really important level. It was pretty much like 2,000 used to be a few years ago, or even 5,000 now. So I'm not surprised that they've come out with another editorial in the FT. It says, precious metals mania is just one area of excess in the financial system. And that's really disingenuous and dishonest because gold has been money for thousands of years. And what gold is telling us and has been telling us for, I would say since the beginning of this century, is that the fiat dollar and all the other currencies that are a derivative of the dollar, all fiat currencies, they're on their way out because we know that fiat currencies, they always go to zero because there's no backing. There's nothing like, let's say, gold that can be used to extinguish the debt because basically banknotes or dollar bills, they're not money. They're just like a promise to pay in money. So the system we're under is completely upside down. They've taken the money out of it, i.e. the gold and also the silver. And they said, well, the promise to pay those now is the money. And the problem with that is that you can't extinguish it. You can't pay it off. And that's why the debt keeps growing. That's why there's $9 trillion for the U.S. Treasury to roll over this year. So that's the bubble. The bubble has been the government debt market, has been the fiat currency, and all this fictitious fairy dust valuations that we've seen since the early 80s. That is the bubble. That is the mania. And all that gold and silver are reflecting is the collapse of the system. And yes, gold and silver maybe got a little bit ahead of themselves in the last month or so, or the last few weeks. But it's not going to go away, and we're going to look at the charts. And that's why I think they're completely wrong. The mania is the fiat currency. I think it's dangerous. It's going to make a lot of people look twice, think twice, and not really protect themselves, because that's what gold and silver are. They are protection against the collapse of the fiat money system. And even Ray Dalio admitted we are right in the middle of this process. And with that, I'm gonna show you some charts, and these are long-term charts, some of mostly like quarterly charts, because I think it's good to look at the bigger picture and see that the fundamentals for gold and silver haven't changed. The fundamentals for the dying fiat currency system hasn't changed. Yeah, hopefully this will calm your fears, or like erase your fears. Of course, many people who don't watch this channel or other channels like ours and only read the FT, they're going to ignore gold and silver, and they're going to be kicking themselves in a few years when the whole system implodes and the only monetary asset left that has any value is physical gold, and also physical silver, of course. So let's start with let's start with the gold chart, the granddaddy, like Michael Oliver calls gold, the granddaddy of the monetary metals. And here I have a quarterly chart going back to the late 60s. And yeah, I mean, it's still early doors here. If you compare the move that we've had since we've broken, we've broken definitively above 2000s back in the beginning of 2024, right? It's a good, healthy move, but you compare it to the move we had from 2001 to 2011, we still have a lot of time left, in my opinion, and a lot of upside left and downside for currencies as well. And if you compare it to the 1970s bull market, the same thing. And this chart, of course, is a logarithmic chart. It's not an arithmetic chart, which makes the current move look parabolic, right? And so to me, you can't even see the correction we've had in the last week or so if you look at the quarterly chart. And I wouldn't be surprised if at the end of the quarter, i.e. at the end of March, we're a lot higher than we're now. It settled yesterday, gold just below 5,000, 4,964.
Mario Innecco's conclusion is simple. The real excess in the financial system isn't gold or silver. It's fiat currency. It's sovereign debt. It's promises that can never be extinguished, only rolled forward. Gold and silver aren't predicting collapse. They're reflecting it. Those who dismiss them as relics may one day realize they ignored the warning. When systems reset, gold doesn't need belief. It simply remains.